Let me just get.
Good morning. Welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Today, we want to talk about our year-to-date performance. It is mid-year, and so it's always good to take a look at it sometime during the year how we're doing. Usually, we like to do mid-year at least, and at the end of the year, and evaluate how the overall performance is. Of course, our team, the Atlas team, is looking at our performance much more often throughout the year
Yeah.
because we are managing your portfolio.
I
But what,
look at it almost every day, actually.
right, right. And then we meet and talk about our evaluation of the portfolio. And that is really the basis of what we're hoping to get across to you today. Because while the Wealth Enhancement Group sends out the quarterly reports that are consistent with the overall firm across all the advisors, the focus is very pointed towards the U.S. stock market and how is
Yeah.
the U.S. stock market doing. Because we use modern portfolio theory and the science behind risk adjusted returns and how we really want to focus on portfolios that are much more um, hopefully robust, better return for any given level of risk. We
Right.
use asset allocation, a very, very diversified portfolio across other areas than the US market. So you know that you're not just invested in the US market, you're invested in a lot of other elements. So, how do you evaluate the performance of our portfolio? Well, the way we evaluate the performance of the portfolio is that we look at benchmarks. We look at what did we use to create the overall asset allocation to begin with, which
Right.
are the benchmarks. And then how are we performing against those benchmarks?
And we have an individual benchmark for each asset class. So that's the only proper way to compare the performance of the individual holdings. We need to look at them in comparison to a benchmark.
Right.
And just to kind of latch on to what you said, when we create our allocations, we use benchmarks to create the allocations initially. Because we don't want to use any individual holding to try to create an allocation initially. And then we try to match the benchmarks as close as possible. In some cases, we beat them. Other cases, we may fall a little bit behind, depending upon the choice of holding we have, which may be a little different from the benchmark.
Well, it often is different than the benchmark because we
Yep.
are taking a little bit of a tactical. So when we say we are strategic asset allocators, we are to a point, but we do take some tactical views of what we think actually might make more sense, and we'll
Yep.
tilt in one way or another. So we're not completely strategic, but the basis of strategic asset allocation is to create use those benchmarks to create the asset allocation. And
Yep.
once you do that, have the faith and the discipline that the math and the empirical evidence that has shown to work over many, many years is going to continue to work. And we've seen it work, again, for the past, 40 years that we've been doing this. So
Yes.
we already have faith in the asset allocation. We want to make sure that we've chosen the right securities to represent that asset allocation.
And
Um,
by the way, a good point about the tactical. We also have in added some of our own influence because we don't just rely on past history. We impose our own views on future returns for asset classes as well. Because in some cases, we may think that the past history is not going to be reflective of the future because we think the return could be was much higher in a certain asset class than it may be in the future. So some of that's incorporated into our asset allocation as well. But we
right.
take long-term views. We don't take short-term views because short-term views are so subject to error. And I see too many firms that say, all right, we estimate the S&P is only going to do 6% a year for the next 5 years. Well, that's problematic because the wide range of potential returns for the S&P over any 5 year period is enormous, and you can miss it by so far, and dramatically underweight to the S&P for as an example. But
Right.
it goes for any asset class, so especially the
And
more volatile ones.
and all of that is being played out
Yep,
again. It's been played out last year to a certain point. This year, really, really
yep.
strong. And so, Steve, if you want to move to the first um,
Yeah,
comparison, oh, well, this just says that we're looking at year-to-date performance mid-year and that our data source for how we're doing in terms of performance and the benchmarks all coming from Morningstar.
yep,
Morningstar Direct, which is an advisor institutional platform.
yep, yeah. And we don't manipulate any of the numbers. They're all from Morningstar directly pulled out. And so here's a U.S. large blend. And so here's an example where we don't exactly use something that exactly mirrors the S&P. We use the Invesco S&P 500 equal weight, for example. And what they do is they, rather than use the type of allocation toward individual stocks that the S&P 500 uses, which is capitalization weighted, instead it takes the 500 S&P stocks and puts 0.2% in each one, and they rebalance, I think, quarterly. And by the way, that's one thing that's really important to know is that you can rebalancing in an ETF does not have the same tax impact on you that rebalancing in a mutual fund would have. So ETFs are really a great vehicle for that reason. Unfortunately, mutual funds have to pay out like what is it, 95 or 90% of all capital gains to you by the end of the year. And so they're capturing capital gains within due to their rebalancing, you're gonna have an additional tax bill at the end of the year.
And if I could just point out, so the State Street, the last fund on here,
Yeah,
is actually representative of the S&P. They're
yeah,
invested directly in exactly what the S&P is, hence why there's no excess or no difference, actually. And because the S&P is heavily weighted in some of these larger Mag 7,
yeah.
more technology, those haven't been doing as well as the
No,
breadth of the rest of the market. And so that's why we're seeing some better performance. You know that we've been slanting away from those heavy technology stocks for a while. And so this
yeah.
clearly demonstrates that that is working and continues to work even into this month as we're moving into the second half of the year.
And I just want to mention the revenue ETF. They build their allocation based on the revenue of the company, not its capitalization. Just to explain capitalization again, that's the number of outstanding shares of a company times the market price of the stock. And so there's a behavioral component of that because we know the market price of a stock isn't always truly reflective of the company's real value. We know that, despite what theories say, we know it isn't always the case.
Right. But they're all ETFs and they're
Yep,
all efficient and
yep,
less expensive and all, they are ETFs, but they have a different flavor to them, as well as in
yep,
mid cap.
yep, yep.
Now,
And so here's the mid cap, and again, we're using the revenue ETF. It's slightly below one benchmark, which is the mid cap value, but it's ahead substantially the second benchmark, which is Morningstar US Mid Broad Value. So it's always dependent on what benchmark you look at, but I think the performance here is pretty good in comparison overall. The wisdom tree has been lagging, and we're actually starting to downplay that in our allocation. While we're not going to necessarily sell it right away because we don't want to create a large capital gain for people if it's in a taxable account. For future investments, we're probably going to replace with something else, and we have added it into our allocation, but I just didn't want to put it on this chart yet.
but Steve, still, we're slanted more towards the Invesco than the.
Absolutely.
So a lot of
Yeah,
times, the actual recipe within the we don't usually rely on only one security to represent
absolutely.
a asset class because we want the different flavors and the different, like we might have a revenue weighted and an equal weighted and maybe even a cash
Yeah.
flow weighted. Yeah, we want to have a little bit of the different strategies in each. Um,
And is a reason for that is because different approaches can fall in or out of favor temporarily. And so we prefer to have a blend so we can smooth out returns in the long run. So
but
yeah.
we tend to accent one over another as well,
Yep.
and
Yep.
oftentimes it is towards more of a value tilt than anything
Yes, it
else.
is. Yep. Exactly right. Yep. And so here's small value, and we're just very close to the benchmark with the Invesco. And what's interesting is, though, even though we do have Pacer and it's been lagging in comparison to benchmark, we just checked this morning and we're actually ahead of the benchmark on an overall basis. In the Russell ahead of the Russell 2000 for our small cap holdings for the year. And again,
That's
the
because we're
revenue.
more heavily weighted towards Invesco. We have
Yeah,
more of the Invesco than the Pacer cash cows. Now we love the strategy about
yes,
of the Pacer philosophy and the approach because they're really focusing on small companies that really are producing solid cash flows,
yeah,
um, which is important in the world of business, as you know. Um, we still, because they're so different than the overall small cap universe, we focus primarily on the Invesco.
that's correct. And by the way, both of these are in effect index funds. Even the Pacer is what they do is they look at the top 100 companies for cash flow in relation to enterprise value for the small in the small cap area, and they routinely invest in those 100 and they rebalance every 3 months, I believe. So if some of the top 100 are no longer part of the top 100, they're going to sell them and purchase the new ones that have now entered that top 100 in terms of cash value in relation to enterprise value. And by the way, just to mention it again, enterprise value is different than book value because these days a lot of assets that are on the books of companies may not fully reflect the true value of the company because it could include goodwill, for example, which we're not going to talk about here, but it's a goodwill is not really an asset. It's more of an accounting asset than a true asset, for example.
Uh,
And
International continues to be a strong asset class. It was last year. It was a really strong. It was much better than actually the domestic, which again, reminds all of us that international has a role in our portfolios. While
yep,
they are, international stocks are somewhat correlated to U.S. stock markets. They're not completely
nope,
negatively correlated. They
right.
perform differently over time, differently enough to create diversification. And that's why they should be there. And last year they did great. This
Yeah,
year
I
they
was going to mention
continue.
that. Yeah, yeah.
Yeah,
It
I
nearly
mean,
doubled the return on the S&P last year, international. It
right.
was up around 30 or 31% of holdings.
And
And I
so
think the
this
S&P
year
was
they're
up
kind of
17
keeping
last
up
year.
with domestic, right?
Yep, yep. And we've always held international. We know again, like anything else, most markets will go through some sort of cycle. And international went through a pretty cycle where it underperformed domestic for a number of years, but we've always held it because we know that there's always this rotation factor, and international become pretty undervalued, and we saw the effect of that last year. By the way, some of that return was also due to currency, a weakening of the dollar too, but not all of it.
You want to mention that while you might notice on this chart that the DFA does not say ETF after it, which is correct,
Hmm.
it is an institutional fund. And so it is stripped down, bare bones fees,
Yep.
and it has they do offer some value with it in the dimensional world. So usually
Yep.
tend to be more value tilted, but
Yep.
we see it's not performing as well this year, although it's slight,
Yeah. And some of that could be the expense ratio, possibly, but
a little.
overall DFAs are very, very efficient, and their expense ratios are pretty low. So it may
Right.
not be that. I didn't check, but so last year, international small cap value went up more than anybody would have predicted. It was up about 50% last year. About three times roughly the return on the S&P. And we've had a small cap value, international small cap value for years. And I've explained many times why we don't like emerging markets and we prefer this instead. And it actually, over the last 20 or 25 years, is actually international small cap values beaten emerging markets by a significant percent and with less volatility, by the way. So we really like international small cap value.
Keep in mind it's developed countries, it's not
Yes.
emerging.
Yep.
And one thing about international, both large cap and small cap, is that other countries also are more heavily weighted in other even industries and sectors. So it does give more diversification of the global marketplace as opposed to just where the US focuses.
And our average allocation international is about 14%, and then generally half of that is an international small cap value. Um, so, and part of it is because it actually provides more diversification because it's less correlated with domestic, even than international larges. Because a lot of the international large companies also may have divisions in the United States, for example, whereas a lot of these international small cap companies don't really have that because they're much smaller.
Real estate,
So,
my favorite asset class over the
me
years.
too. Always
I mean,
has
it's
been.
over the years, you had to have real estate, and I'm not
Yep.
talking about your primary home or,
No.
rental property. I'm talking about diversified real estate all over a lot of sectors,
Yes.
warehouses, storage centers, data centers, all of it. Um, Great performing asset class. I I think one of the top performing asset class if you looked at like the past 20 years, 25
Hmm.
years, it had to be the top performing asset class
Yep.
more years than any other asset class, right?
Yep.
I
And it did lag in performance prior to this year for the two or
right.
3 years prior
Which
to
is
this
why
year.
people left the asset class.
And we
But
never did.
we stuck to it because we knew it was
Yep.
going to do good. And even so, this is as of the end of June. Now,
Yep.
as of today, which is the middle of July, July 22nd, we are up in real estate. I wrote it down 17%, 17.5% as of today.
And
So,
that's about 7% ahead of the S&P for the year.
yeah.
Obviously, S&P is not not an appropriate benchmark, but still, it just shows you the value of diversification by asset class.
Uh-huh.
Who could have predicted that, right?
Yeah.
By the way,
And,
this is one of the few areas where we actually use an active manager, by the way.
and look at the excess return.
Yeah,
These guys know what they're doing. I mean, Cohen and
yeah,
Steers, I mean, both of them, they've been around a while and they know how to really make sure to navigate towards the right sectors of the asset class.
that's correct. Because some sectors, we don't. I don't think there's a great future for some sectors. For example, large malls. I mean, a lot of large malls in New Jersey actually even closed up. They lost their anchored tenants, and because let's face it, more and more of their retail sales have gone to places like Amazon, in places that instead of having a mall, you don't have to go to a mall to look at a tool, for example, if you're going to buy it. You can buy it online and you can get it the same day. Actually, I did that recently with Amazon. I got a tool in the same day that I needed.
Right. And they're slanted away from that. And Steve, the
Yep.
thing that this is the whole conversation about, oh, you should be passively managing your portfolio. And
Hmm.
the truth is that when people say passive, I always want to say, what exactly are you talking about? Are you talking about
Right.
a passive position in the S&P 500? Okay. But this asset class is not an efficient asset class, and
No.
um, a passive approach to it might not be as wise. And
Yep.
we did, if you recall, several years ago we were trying some ETF, more passive. Vanguard, I think we didn't
Yes,
we wound up kind of moving out of that, but
we did.
we were trying, and every time we talk to people, we'd say, yeah, well, look at the passive and look at the active.
Yep.
And this is net of their expense ratio. So
Yeah.
why, who cares about the expense ratio if they're
Yeah.
not performing,
Yep.
net, you're better off.
But what I want to mention, I've been using Conan Steers, that particular fund, for about 30 years because they've always been one of the best choices within this particular asset class. And they've always been a 4 or 5 star rated. Not that we go by the ratings in Morningstar, but they've always been high in the ratings at Morningstar. But one good thing about Cohen, they knew enough to start to move away from malls and that type of thing. Instead, they were allocated toward cell phone towers, storage units, and warehouses because guess what's happening? The retail malls are turning into huge warehouses now. For example, that Amazon has. They built some huge ones here in New Jersey, I know. And by the way, they have robots running through those warehouses to pick the items, and that's why they can. One of the reasons they can deliver so quick. It's really an astounding thing. But
Th-
Cohen Steers knew this to
This
their
is when you
credit.
want to go with a specialist, and they're a
Yeah,
specialist
better believe
in this
it.
area.
Yep, yep.
And the next one is probably why I said real estate is one of my favorite. Commodities
Yeah,
is one of my most frustrating asset classes. It
it
frustrates
is.
me all the time because it is all over the place, but not the
Yes.
past couple of years. It's been a
No.
performer, right?
Our last 6 years, surprising, has been one of our best performing asset classes on average over the last 6 years, which is, who could have predicted that, right?
And Steve, this month, I mean, what we're showing a 19.6% return as of the end of June. As
Yeah.
of now, July 22nd, it is up by our holdings, which is a combination of these two funds
Yes.
generally, is up by around 31%, 31.6%, which
Yeah,
like I don't know what, well, I do know what's happened in July is primarily the oil and the
it
energy
is.
focus, which these two funds are more heavily focused on energy. I think they're more heavily focused on industrial metals as opposed to
Yes.
just precious metals and
Yes.
even things like livestock. But they have their benchmark, they're I don't know what, I think one is 16 commodities, the other one's like 14 commodities. So it's a basket of commodities.
That's correct. Yep. And they're
Look
both
at that.
performing really, really well. And again, that's asset allocation. It's when we're hit by pretty high inflation. I think it was in 2022. The natural resources funds really outperformed, and it actually helped provide some strength in your portfolio against inflation because inflation did hit bonds and other things because interest rates rose.
Right.
Um, so
So it's asset allocation, but when you see this kind of excess, which some people might call alpha,
right.
is you can say, clearly we're able to pull out by using these funds some of the real benefits of those asset classes. That
Right. And by the way, this is one area where we try even though they're ETFs, we try to put this in your if you have a tax deferred account, we try to put this in a tax deferred account because in particular the Invesco, it made a huge payout of income that they captured on their commodities trades. And by the way, they don't buy commodities outright, they buy futures, both of them, which is an important point. But they paid out about 30% of their net asset value as income in 1 year. So that's why I've always tried to put these in tax deferred accounts if we can.
if somebody has a tax deferred account,
Yep,
there are a couple of
yep,
situations. Some of you have only taxable money, in which case we
yep,
you put it in your taxable accounts. We have tried to play some games um, of looking at when the dividends are being paid out and moved in. I don't know how successful that has been.
yeah,
We of course there's the wash rule, so we have to be careful about that.
yeah.
And
And
it's
it's always a little dangerous to get out of it. This is a pretty volatile asset class, and as we see now, through the end of June was
19 to 31%
exactly that's
in
the
six,
problem.
yeah, what, how many days? 22 days?
And
Uh,
so, yeah, exactly. So if we try to sell it before the income is paid out, the fund could go up 10% in a month, and guess what? Ultimately, we really didn't help you. So that's why we're really cautious with doing that with really volatile asset classes. By the way, so and who can predict this? I mean, no, nobody really. You know, so. Here's another asset class that we've actually held for about 30 years, and I don't understand why more advisors don't hold this asset class. It's provided about 80 or 90% of the return of the S&P 500 long term, but with about 60 or 70% of the risk. And these are convertible bonds, which we've explained many times. We've done videos on them, and if you go to our YouTube channel, you can find a video on them. I think we've talked about them in the past, but effectively, just as a reminder, these are bonds issued by corporations that have an option attached to them, and you can at the bondholder's discretion, you can convert the using the option convert the bond into the stock of the company that issued the bond. So it becomes when I don't want to get into the conversion ratio and all that stuff. We can explain it to you if you want to contact us as
no,
well.
it's
Anyway,
complicated.
yeah. But what happens? It becomes equity-like when the stock price goes above this conversion break-even price. But if the stock market is performing poorly, the value of the bond and you won't convert when the stock price is low, becomes more bond-like in its behavior, and it's based more on the coupon paid out on the bond. So
So just while we're on this slide, I do want to
Yeah,
kind of give folks an understanding of how we operate. You know, when we're looking at our performance of the different securities against the benchmark from month to month, we will look at something like a State Street and we'll say, gee, you
yep,
know, it's underperforming versus iShares. Why is it underperforming? There are times where we'll actually call the fund manager and talk to
yep,
them. We'll look at, you know, kind of get a sense of it's underperforming because they're really drifting away from their initial what they initially agreed to do, or they're doing something that we don't like, in which case we may at that point in time decide it's time to switch out of that and find either move to the iShares or move into
yep,
something else.
yep,
But this is we're really monitoring how the securities are representing the overall asset class and whether there is something better. And so there's
yep.
a bunch of funds that are sitting on the bench, if you will, that we're also monitoring to make
Yep.
sure that, you know, are they a better choice than what we're currently holding?
And also, we do that, but we're also cautious in terms of making snap decisions
Mhm.
because many times we've seen something underperform for even for 6 months, and then suddenly it becomes the winner after that. And so we're cautious. But if something consistently underperforms, we're going to make a change. And by the
Right.
way, both of these in these cases they're index like. They're not really active managers per se. But still, it could be the way they construct the index. You know, it may not be the way we want it. We think it's the right way going forward. And that's why, for example, we have the in the large cap domestic area where we have the equal weight because we think that there's in the long run, there are distortions that can affect the performance of the S&P 500, especially when you have 10 stocks that become 40% of it. So we do look at these things in that regard too. And we will make changes. In fact, I mentioned earlier in the mid-cap area, we're downplaying one holding, and then we're going to gradually replace it with another holding we think will be better in the long run. So, so here's an area where we really only have one choice, unfortunately, because there really are not any other real good choices in this area. In fact, this asset class is relatively new for us, is 8 or 9 years old, but it's been a consistently high performer, and it adds a lot of diversification to our portfolios. It's a 6-year average annualized return, which is not here, but it's been about 9% a year. And the bulk of that's actually paid out as income, not necessarily by appreciation in an NAV. And you'll see the NAV go up until they make their quarterly income distribution, and you'll see it back drop down because you've got the rise in the NAV as a income payment, a dividend payment on this. But it's a great diversifier because it doesn't have any correlation with almost anything else in
Right.
our portfolio, the reinsurance
And
bonds.
that's the biggest reason for holding it, truly,
Yep,
is the diversification. And then the
yep.
extra performance is icing on the cake. Uh,
It sure is.
And we're showing two benchmarks here because, you know, are we comparing ourselves to what a normal bond would do? Well, if that's the case, it's way
Yep,
outperforming a normal bond. If we're
yep,
comparing to um, the Swiss Global Catastrophic Bond um,
yeah. Index. Yep,
benchmark, it's still over, but not as much. Um, but
yep.
we like this asset class, and we've been following. There are a couple of uh, uh, experts in the industry that have been touting this fund for a while. It is not a fund that retail investors can get access to.
Now,
It is something that you can only get through a fiduciary advisor, uh,
yep.
and so we like this one too.
Yeah, I like it a lot. And when I remember when they first introduced it to us, the company came in and spent 2 or 3 hours presenting the details on this fund to us. And I like the concept right away. And it's held up well,
Isn't
even
this
when
how
Hurricane
Buffett made a lot of his money?
Yeah,
Yeah.
yeah. Even when Hurricane Ian hit Florida, because reinsurance bonds are sensitive to climate-related events, hurricanes, but also events related to earthquakes and that type of thing. Even when Hurricane Ian hit Florida, this particular fund was down about only about 3% that month, which is not bad at all,
Well,
considering.
if you think about it, they're just going to raise the premiums. And I mean, insurance companies are going to make sure that they're okay. Um,
Exactly.
so,
Yeah.
it's, you can say it's not right. But we're going to play the game. Fine. If that's what you're doing.
What was funny after that is because the following year, I think this fund returned about 17% or something along those lines. It was crazy. When I spoke to the fund manager, they said there was a complete repricing in this in the reinsurance bond market that led to these enormously high returns. The premiums paid by the reinsurance companies to the trusts that hold these bonds was much higher. So, we because of Hurricane Ian, they actually benefited. Who
Right.
would have thought that, right?
Well,
Crazy.
yeah. And this includes cat catastrophes all over the world, including
Yeah.
tsunamis in
Yep.
Asia, all kinds of California fires, Canada fires, whatever.
All of it. That's right. Yep.
Yeah,
Yep.
I think that's the last
Yep.
actually asset class that we're showing. I do want to mention what we're not showing on this presentation is domestic or international fixed income.
Right.
I have to say that if you look at your performance on your quarterly reports, it's very disappointing, or on your accounts through Schwab or Fidelity, you'll see that the overall return is very disappointing. And
Yep.
that is on paper. When we look at domestic bonds, because we use individual bonds in our portfolios, they are going to deliver what contractually they are supposed to deliver with their
Right.
yield to maturity through the coupons and the overall maturity of that bond. But the valuation on paper will fluctuate up and down. And the reason why it is fluctuated down this year is because the long-term rates have gone up, and there's an inverse relationship between the valuation and the price, the interest rate. So
Yep.
it's not something to be alarmed by, but it will show, it actually is putting a little bit of a weight on your portfolio. Now, having said that, Steve, what was the year-to-date performance of our average portfolio across all of our conservative versus aggressive portfolios?
Somewhat over, I think, did I say 9%? Roughly about nine, I
Okay.
think.
So a half a year
Yeah.
performance, even with that fixed income kind of pulling it down a little. Um, So, that's kind of the nature of the beast. We are always going to have an asset class that
Yep.
isn't fully performing the way the rest of it is. That's what you expect from asset allocation. That's what you want from asset allocation. If you
Exactly.
don't have that, you are not fully diversified.
Well, that's that. If everything goes up in the same year, it's a good chance everything's going to go down in the same year.
Right, right.
And if you don't build an asset allocation strategy properly, and that's what you don't want. But what you do know, just the very nature of asset allocation, as you mentioned, in a great year for the market, you may have some things that aren't performing as well. But guess what? The following year, they may be the winners. So we just can't accurately predict year by year in the short term who's going to win and who's going to lose. Perhaps longer, perhaps more in the long term, but not in the short term.
And so this last slide, so it's halfway through the year. You might be asking, well, what do you expect for the rest of the half of the year?
Right.
You all know us. You know that we're telling you that our crystal ball is a little bit cloudy, and we really
Yeah.
don't know. A lot of it
No.
is going to be a function of all the geopolitical things that are transpiring around the world, which we're not going
Right.
to get into. We're not even going to bother to try to understand. I mean, I can give you all the arguments on economists that are saying interest rates are going up, others that are saying interest rates are going down, all kinds of things. We rather stay away from that and say, you know what, we're going to stick to our guns and say asset allocation, diversification will weather any storm that we see coming. So rather than focus on that, we can tell you what we do know. And what
Right.
we do know is that there has been the introduction this month of an opportunity that we think is worth mentioning. Um, while we don't want to really get into the details of it
No, we're
today,
still
um,
examining it ourselves. So,
right, we do think that these accounts that have been initiated for our younger people are going to be very advantageous to take
Yeah.
advantage of over the long run. It looks like there's an opportunity that our babies and our young people are could potentially graduate high school or college with a nice nest egg that I'm not even I believe that we'll be able to actually convert at that point some of this money to a Roth
Yeah, I
account,
think
which is a
so.
very interesting idea because your earnings at that age are very low.
Yep.
So why not do that?
And by
It's
the way, I want to call out Michael Dell, Michael and Susan Dell. I mean, what a generous contribution,
Yeah, they've really added to the
you
value
know.
of this whole thing.
And people who they billionaires, they get a lot of criticism, but this I think this is great because it's also kind of teaches it's going to teach young children a little bit about capitalism, and our economic
And
system.
how the markets work.
Yeah, that is how the
And
markets work,
and it
and
is a step towards trying to, we talk about the inequity of uh, households throughout our country.
yep,
Um, Hopefully, this will help elevate some of the households where they
yes,
will
I hope
start
so.
having real participation in the market because it's participation in the markets that enable people to really see growth.
That's correct. And look, again, also, I think it's going to help teach children that capitalism really is a good system. And I always like what Winston Churchill said, capitalism leads to unequal results, but socialism leads to equal misery, a sharing of misery.
Mm.
I think that was well said. But I think this is great. Parents can use this as a teaching opportunity for their children too, to show them what they have and explain to them through the years and have them watch it. And I think it's a great thing.
Right.
But I think Elon Musk said they're going to. I think it was actually Gwen Shotwell, the president of SpaceX, said they were going to. Her and her husband were going to contribute SpaceX shares to this, I believe, as
Oh,
well.
wow. Okay.
Yeah,
Yeah.
Gwen Shaw, very impressive lady, by the way. If you don't know anything about her, I'm saying look her up. Very impressive lady. She runs SpaceX for
Okay.
Elon.
Progressive, Steve. This is too many words on in one's life.
I
Makes
know we're not going to go over that.
um
All right.
so yeah so generally we always feel very very strongly about the way our um choice of investing works. It's not something that Steve and I invented in a closet. It's based
No.
upon the science and many years of research. All the body of knowledge around investing points to investing the way we invest. And there are years where it works really, really super, and there are other years where you sometimes kind of wish that you weren't invested this way because the US market is just so much on a tear that you want
Yeah,
to actually just be all in the US market. I can tell you that the data shows that over the long term, this does point towards usually the opportunity for better results.
and we have the data too, so
Right.
we,
So
we, we we've analyzed it.
we're happy to talk more about it, but we think we wanted you to see how we're evaluating performance and to get a sense of how your portfolio is doing. Thank you for listening. If you want to know more, we're always available to have a conversation. So please reach out and let us know. Until next time, bye.